Can you actually live off dividends? Is this a realistic plan? Let's be honest. Who doesn't dream of money box money? You know, the idea that you can wake up, check your phone, and see cash deposited right into your account from companies you own a piece of. No alarm clock, no boss, no begging for that 10% raise, just pure passive income. It's the ultimate financial goal, sitting back and letting your money do the heavy lifting, so you don't have to. But can you really live off that money? Is that a realistic goal for a regular person with a normal job? Or is it just a fantasy promoted by influencers with $1 million portfolios? So today, we're going to break down an example of the math on what it takes to generate a livable $50,000 per year from dividends, and then reveal 3 silent destroyers, the common pitfalls that can turn this dream into a financial nightmare if you aren't very careful. Please subscribe to support our work, like, comment, and share. It will make a big difference with the YouTube algorithm. And check out our courses on Udemy, like IT Support Quiz Course, link in the video description. Thank you. But first of all, I would like to make it crystal clear that this is not any kind of financial advice. This simple math to financial freedom. Alright, so how much do you actually need to pull this off? The formula at the heart of it all is refreshingly simple. Just take your desired annual income and divide it by your portfolio's average dividend yield. Your goal annual income divided by your dividend yield equals the portfolio you need. That's the blueprint. But the secret, as always, is in that dividend yield. The percentage you target will radically change the size of the nest egg you need to build. Let's stick with our goal of $50,000 a year in pre-tax dividend income. That's a solid number that would be comfortable in many parts of the country and around the world. If you go with a conservative, high-quality portfolio, think blue chip stocks or a dividend ETF focused on safety, you might aim for a 3.5% yield. Using our formula, that means you need more than $1.4 million. What about a popular dividend ETF like the Schwab US Dividend Equality ETF, SCHD? It's famous for its quality and dividend growth. For a yield around 3.87% to get $50,000 from SCHD, you would need about $1.3 million. But then you see those tempting stocks with huge yields. What if you build a riskier portfolio averaging a 7% yield? Suddenly, the math looks much friendlier, and you need around $715,000. On paper, that looks amazing, almost half the money for this same income. And this is precisely where so many investors get into deep trouble. They see the high yield and forget to ask the most important question: why is it so high? To make this real, a dividend aristocrat like Johnson & Johnson, J&J, with a yield of around 3.16%, you need over $1.58 million to hit your $50,000 goal. Compare that to a company like Altria MO, the tobacco giant, which has a massive 6.95% yield. You'd only need about $719,000. The math is easy, but the choice is not. Do you spend more time building a larger, safer portfolio, or do you take on more risk for a faster path to your goal? This is where we run into our first silent destroyer. Pitfall number 1, the unrelenting march of inflation. Getting $50,000 in dividends this year is fantastic. But what about next year and the year after that? That $50,000 doesn't hold its value. Inflation is constantly, silently eating away at your purchasing power. Think about it. You grind it out. You build that perfect $1.25 million portfolio with a solid 4% yield, and boom, you hit your $50,000 income goal. You've made it. But then inflation creeps in at 3% for the year. Now your groceries, gas, and healthcare all cost more. Your $50,000 of income only buys what $48,500 could buy last year. And after a decade, That creeping inflation can steal a third of your income's value. And this is the massive mistake people make when they focus only on the current yield. A high dividend that never grows is a losing game. You don't just need dividend income, you need dividend growth. You have to own companies that give you a raise every single year, a raise that crushes inflation. This is why serious investors celebrate dividend aristocrats and dividend kings, companies with bulletproof track records of increasing their dividends for 25 or even 50 consecutive years. A company like Johnson & Johnson doesn't just send you a check, it has a 53-year history of making that check bigger. That's how you protect yourself. Your income stream has to grow or your dream will slowly die. Pitfall number 2. The taxman always gets his cut. Okay, so you've planned for inflation, your portfolio is humming along, and then you get the tax bill. Because dividend income isn't free money, it's taxable income, and forgetting this fact can lead to a very nasty surprise. In the US, your dividends are taxed in one of two ways, qualified or non-qualified. Qualified dividends are the goal. They get special treatment and are taxed at lower long-term capital gains rates. In fact, for 2025, if you're married, filing jointly, and your total taxable income is under $96,700, your federal tax rate on those qualified dividends is 0%. That's right, 0. Above that, the rate jumps to 15% or 20% for top earners. To be qualified, the stock has to be from a U.S. company or a qualifying foreign one, and you have to hold it for more than 60 days around its payout date. Non-qualified dividends, on the other hand, get taxed at your regular income tax rates, which can go all the way up to 37%. This is where dividends from investments like real estate investment trusts, REITs, often fall. Let's go back to our $50,000 goal. If that is all qualified dividends and you're a single filer, you might pay very little in federal tax since the first $48,350 is in the 0% bracket for 2025. But if a big chunk of your income comes from a high-yield REIT, that portion will be taxed at your much higher personal rate. Every single dividend you receive in a regular brokerage account creates a tax bill for that year. Even if you reinvested it, it's a forced tax. You can't defer. The bottom line is, you have to plan around your after-tax income. What you actually get to keep is the only number that matters. Pitfall number 3, the siren sound of high-yield traps. And this brings us to the most dangerous pitfall of all, the one that wrecks more dividend dreams than anything else, chasing those ridiculously high yields. I mean, you see a shocking payout 8%, 10%, or even 12%. And of course, it's tempting. The math suddenly looks so easy. But you have to stop and ask yourself, why is the yield so high? Remember, yield is just the dividend divided by the stock price. So a yield gets huge for one of two reasons. Either the dividend payout is massive or the stock price has fallen off a cliff. And here's the hard truth. A super high yield is almost always a massive red flag. It's a warning sign from the market that investors are dumping the stock because they believe the business is in trouble and a dividend cut is coming. It's called a yield trap. You buy in for the juicy payout and then the company slashes the dividend, causing the stock price to crash even further. You end up losing both your income stream and a huge chunk of your initial investment. Plus, a portfolio built only on high-yield stocks is usually a ticking time bomb of poor diversification. These companies are often clustered in risky sectors like energy or tobacco. Real financial freedom isn't built on a house of cards made of a few high-risk stocks. It's built on a diversified foundation of quality companies that have the strength to not only pay, but grow their dividends for decades. Building a portfolio can actually support you in a marathon, not a sprint. It's about strategy and patience, not just picking a few stocks with big numbers next to them. So let's circle back to the big question. Can you actually live off dividends? Well, it depends, and it's not a get-rich-quick scheme. It demands a real plan. You have to understand the math, prepare for those silent killers like inflation and taxes, and most importantly, you need the discipline to ignore those tempting yield traps and focus on quality. When you live off dividends, you're paying your bills without ever having to sell your assets. You've built a financial machine that works for you, one that can even be passed down to future generation, and it takes time and consistency. So what's your thought on living off dividends? Is it possible or not? Share your thoughts in the comment section below. Please subscribe to support our work. That's all we're asking, and thanks for watching.